Welcome to Summit Credit Union's Healthy Finances Workshop. My name is Lindy Fuller. I'm presenting today along with a distinguished panel of industry experts in order to help each of you make healthy financial choices. I'll be monitoring the chat so that we're sure not to miss any of your important questions. And if you don't mind, stay muted unless we call on you to speak. You can use your electronic hand or you can put something in the chat and I will be happy to introduce you or share your question. So today my colleagues and I will be discussing how part of making healthy financial choices includes building your savings, protecting your financial assets with insurance, our Raise, Lower, and Eliminate initiative, how to avoid credit pitfalls, managing credit strategically, qualifying for a mortgage, and investment and retirement planning. So lots to discuss. We're going to start with savings. Now, building a savings program is part of what I like to call your basic financial nutrition. Experts say that we should have a minimum of 3 to 6 months of our annual gross income as an emergency fund. If we pay ourselves first using direct deposit to put a fixed portion of funds into a savings each day, we can build a savings with little to no financial pain. Regular and special savings are an ideal place to start and maintain your emergency fund deposits. There's Christmas Club, which helps you save for the holidays. It earns a little bit more and you can deposit year round, but you're only allowed to withdraw during the season. So October 1st to December 31st is when those funds are available. Now, money market is a savings that allows for more dividend earnings when you plan to keep a minimum balance of $1,000, while the money market investor earns more for minimum balances of $10,000, but you still get to retain some liquidity. Now, certificates of deposit or CDs start with a minimum of $500, while jumbo CDs start at $10,000. These have more dividend earnings than regular savings with less liquidity because they hold your funds between 6 and 36 months. Now, our kids can save too, and they should be. With our Kids Club savings accounts, they can earn age-appropriate prizes during their birthday month. We offer coin machines, Taste of Reality workshops, and Zogo. That's an app designed to educate kids of all ages to earn points towards gift cards that they can cash in just for learning about financial responsibility. Moving on from basic nutrition, let's go to our dietary supplements. Protecting your financial assets is like taking your vitamins. So rather than maintaining your physical health, this protection builds immunity to paying for losses associated with our vehicles and homes being hurt. At Summit Credit Union, we've partnered with the Needham Group, Incorporated, to provide a full suite of affordable insurance solutions. Now, Vicki Hill is our in-house associate insurance agent. Vicki, how can you provide insurance solutions?
Good afternoon, everybody. Thank you for joining us. We appreciate it. As an insurance agent, it's my job to put together a plan to protect your assets and your investments. And that's going to be based on your individual, your specific needs, whether it's your auto, your home, renters, or your commercial business. We can provide coverage for those things. We have a lot of different companies, national companies such as Nationwide, Travelers, Progressive, for your auto and your homeowner's insurance, and also Liberty Mutual to cover your commercial ventures that you may have, as well as toys such as your boats, your RVs, your four-wheelers and things like that. We can cover those as well. We also can compare your current declaration pages with your current carriers, go over your coverages, make sure that you have the coverage that you need, the coverages that's more specific to you, not what your neighbor has, but what you need. And it's not always best to go with state minimum coverages just because it's a cheaper price. You need to do what's best for you specifically. And whenever you're ready to purchase a new home, or if you're refinancing, or if you're buying a new vehicle, or just ready to change your current insurance carrier, just get in touch with me and I'll be happy to go over your coverages and your declaration pages and see what we can do for you and see if we can save you some money with some of our carriers.
Thank you, Vicki.
You're welcome.
At the end of our presentation, we'll share all of your contact information with the group so they can give you a call and get taken care of.
Thank you.
Now, our initiative to support healthy finances at Summit Credit Union is simple. We want to help you raise your credit score, lower your auto payments and insurance premiums, and eliminate your high interest debt. I know everyone wants to raise their credit scores, but why? Well, if you can think of some good reasons, by all means, put it in the chat. But don't people generally equate higher scores with lower payments and lower premiums? And ultimately, doesn't that equal savings? Now, some debt is good, but why? Well, we have to establish and maintain credit so we can offset low periods of cash flow. Some examples of how this initiative can really work for you. One comes to mind. Let's say you have a $500 line of credit, and this backs up your checking so that you can avoid non-sufficient funds fees. That gives you purchase freedom. That way you don't have to worry too much about a little overage here or there and it causing a bunch of fees and a snowball effect in your account. Another example might be where you've got a $15,000 balance and 51 months left to pay on your auto loan with the bank. The loan is at 7.5 and paying about $350 a month. But you want to refinance it with the credit union, and you can get 3.75 to be paid off in the same 51 months. But now your payment's only $320. That's a savings of $30 a month. And over the course of the rest of that loan, that's over $1,530 less that you're paying. So if your bank loan rate is higher, that savings can even be higher, because I was pretty conservative on that 7.5. Lots of banks are charging much higher interest rate. So that's one other way. The third example, well, maybe it's insurance renewal time. Our on-site insurance agent, Vicki, gives you a quote for a lower premium on your car and your home insurance. She saves our members an average of $530 a year. Is it time to take your financial vitamins? Well, you'll definitely want to speak with her later. Next, we'll want to avoid credit pitfalls and save your score. Allowing consumer loans to be paid 30 or more days late is so costly. How many points would you lose for being 30, 60, or 90 days past due? Any guesses? It takes only moments to negatively impact credit scores and years to recuperate the lost. If you can't avoid being late, protect your score by paying no later than 29 days late. That way, even if you have a late fee, you'll avoid paying credit score penalties for up to an additional 24 months. Fortunately, you can't lose more than 150 points for those past due consumer loans at a time. Helen, I'm glad you were able to finally join us, and we've got volume, dear. Yay. All right. Now, home loans and collections have even weightier score consequences. Unless there is an error to dispute, only time can heal these items on your credit report. Notice how much more significant that is. Those points are huge. And because they are staying on your report for at least 24 months, it's important for us to realize if we can avoid those things, we should. So what do we do with some of this knowledge? Well, we want to take it personal. Knowledge is power. When you know your score, you understand how to improve it, along with what to avoid, you can become healthier financially. The credit score analysis is set up that way. The better the score, the better your loan rates are going to be, your home and auto insurance premiums will be. So what you can do is call our member service department and schedule a credit score analysis. They go line by line through your report at the branch of your choice. And if you prefer to do it virtually, I take care of all of the virtual credit score analysis for the credit union. And I'm happy to present that and even virtually share all of the documentation so that you can feel confident that you are fully aware of everything that can impact your score. Now, if you happen to have had one of these before and want to share, by all means do that. But I would say definitely, if you've not had that done in the past, reach out. You don't have to be a member to do that. But I will tell you, probably 95% of folks that do and aren't members become members because they see the value in it. And we are all about sharing because that is caring. All right. Now we're going to hear from our area mortgage originator, Dirk Spainhour. He's going to discuss steps to home ownership, how your credit matters when qualifying for a mortgage, and understanding those mortgage specific terms. Dirk, you have our attention, sir.
Thank you very much, and welcome to everyone on the video today. We're going to talk a little bit about buying and owning a home and refinancing. We've got a few things there that I wanted to throw out as far as what we look at and what we want our members to look at. Understanding your credit, and it kind of goes back to what Lindy was talking about. To buy a house and to refinance a house, anytime you're doing any kind of new mortgage loans, you really want to know where your credit is and what you qualify for, the rates. So by understanding your credit, you'll know exactly where you are and what to expect as the process moves forward. Also, determine how much house you can afford. A lot of times what people want to buy, and you want to take it to the maximum and what can you afford and what's the most you can get. But that can always put you in a precarious situation if you're not careful. So when you get pre-approved, you want to make sure you know what that does and the amounts does for you and what it does to you if something was to go wrong. Understanding your mortgage loan options. There's always options in the mortgage world. You got to find the one that fits your needs the best. All right. You may have a lot of different companies have different programs. So XYZ Bank may have a better program than ABC Mortgage. You just never know. But what you want to do is make sure you know what options are out there. And hopefully if you get with a loan officer such as us here at Summit, we try to tell you the other programs that's maybe used nationally so that we can make sure we put you in the right position. Understanding a pre-qualification versus a pre-approval. That's a big item especially in today's world. A pre-qualification is no more than someone telling a loan officer how much they make, how much their monthly bills are, and that's what you qualify for. Nobody's really looked at anything and really gave you the sign off on it. On a pre-approval, most of the time we know what your credit is. We've already pulled it. We have it. We know the income. So as long as the house or the numbers match up, you're pretty much good to go on a pre-approval. It's always best to get a pre-approval versus a pre-qualification. And then if you're buying, finding the home that meets your needs. If someone sits down with me that's a first-time home buyer, one of the first things I ask them is, where do you plan to be in 5 years? If you're single today, are you planning to get married soon? Do you plan to have children? If the answer is yes to either one of those, and they're telling me, well, I wouldn't mind just a little small 1 or 2 bedroom house with 1 or 2 baths. Well, in 5 years, if you're getting married and planning on kids, that's going to pretty much be a sale right there. You're not going to be able to stay in that house. So stuff like that is questions I tend to ask to make sure I know where you as a borrower is trying to go. Also with the credit scores, as we see up on the screen now, credit scores are a huge, huge item in the mortgage world. A credit score is a computer generated number that basically predicts what your likelihood of paying back that loan or delinquency will be. It is very, very accurate. And unfortunately, in today's world, it's being used to help determine approvals or denials. In a mortgage report, we get 3 scores. We get one from Experian, Equifax, and TransUnion. Now, I know a lot of you have heard the term Fair Isaac or Beacon or my FICO score. Each one of those programs is associated with a specific group, but the true technical names from those companies are Equifax, Experian, and TransUnion. The mortgage departments are the ones that typically pull these tri-merge reports. The scores are range anywhere from 300 to 850, and they can move around. As you can see, what we just put up here on this at the bottom, the score needed in the mortgage world, FHA, which is a fixed rate government-backed loan, and a lot of people use it for their first-time homebuyer loans. Minimum score for those guys are 640, and the conventional loans typically start at 660 and go up. I do want to throw something out while we're talking about FHA. I know a lot of people will Google FHA and you'll see on their site it says they'll do loans down to 580. However, FHA requires PMI insurance on their mortgage loans, and PMI insurers will not insure those loans under 640. So basically, even though they say they'll do them, you can't get the required insurance to cover that loan through what they call the back end market. And I'm not going to say false advertisement, but it's very hard to get those loans when you start getting under 640. Qualifying for a mortgage. What do we look at? First of all, income. We want to know what your base income is before any deductions, and we do not want to know overtime or any kind of bonuses. There is a lot of technical issues in that, but base income is what most people base it on. We also look at your assets. What kind of savings accounts do you have? What kind of investments, 401ks? So we can help determine how much can you afford for a down payment or closing costs. Credit worthiness. We go back to the scores and what does your credit look like? Your debts. What do you have, in debts? Car payments, other homes, credit cards, student loans, alimony, child support. Look at the property. What kind of property do you have? Are you trying to buy or refinance? Is it a house? Is it a townhouse, a condo, a manufactured home? What do you actually have? And then we look at what we call life events. We have it here as a bankruptcy, but a bankruptcy or foreclosure, you typically need to be out of it about 3 to 5 years in today's world to do a new one. So we're going to define some terms real quick debt to income ratio. And the reason we brought this screen in is just in the past screen, we were talking about income versus debts. That's how we come up with this ratio. It is a very simple formula. We take your debts and divide it by your income. What qualifies for income again? Your salary, your base salary, child support income if it's court ordered, alimony if it's court ordered and being paid on both of those, and any other income such as part-time jobs or something to that nature. If you've got a part-time job, you have to be on both jobs concurrent for 2 consecutive years to use both jobs. Debts include car loans, student loans, credit cards, again, alimony payments, child support payments, another mortgage, the current mortgage loan that we're getting ready to do for you. We take those and divide them by each other. The monthly payment on this new mortgage with all your debts included should not exceed 43% of your gross monthly income. There is a few companies that'll go higher, but you better have a lot of information backing up to support that you can afford greater than 43%. The other little defining term that we like to talk about is loan to value, or LTV. That is simply the purchase price or appraised value divided by the loan amount. If you're buying a house and you qualify for a 97% loan, and you're buying a $100,000 house and the loan is $97,000, then you're doing a 97% loan. If you're refinancing, same thing. There's certain caps on those numbers that you cannot go over. That's why we talk about what is your loan to value. And I believe we're coming to the end of my slides here now, Wendy.
Yes, thank you, Dirk. We're going to ask some questions later and get more information on the down payment. So stay tuned. Also, if you all have questions for Dirk, be thinking about those so that we can answer those towards the end. Now we're going to introduce our on-site certified financial planner, Mark Lopresti. He's going to review highlights of what he has to keep your finances healthy. Mark?
All right, great. Good to see you all. And if you have questions at the end, by all means, I just want to introduce you to the part of Summit that we help, where our members are able to quit their jobs. We help our members save, building for retirement, building for any kind of goal to be able to quit their jobs, retire at the beach, get their kids through college, all of those things. Here at Summit, we're full service asset managers. We've got one of the largest advisories in the Triad. And I'm going to give you some ideas today on how to start building for those of you who think you can't. We can easily talk about investments, but until we have money to do it, it's hard to do. So I'm going to give you what I see as 3 of the biggest mistakes or biggest opportunities for people to start to build for their retirement. These are ways we spend our money that we might be able to change. And I'm going to show you how big of a deal it is. Things that we take for granted, like I've identified 3 sources for how we could save more. One of them has to do with buying cars. Another has to do with lunches during working hours. And the last one has to do with buying houses. We all do those things. So these are great ways to start. I want to point out to you that very often we don't think about decisions like buying cars. And we just go out and do it. We need a car. We go to a lot. We go to a dealer and we buy the car. I want to point out that if you made the choice of, instead of buying a brand new car, and instead decided to buy a used car, the difference of payments unlocks your ability to save. So just to give you an example, these may be a little low now, but if you were, for example, to try to buy a $45,000, at the time I wrote this, a luxury car, nowadays that might be a sedan, it might be a normal car. I know prices are going up, but if we chose, instead of buying a $45,000 luxury car, instead bought a $15,000 used car, those are still available. I just helped my son buy one just a few months ago. What you'll find is you saved yourself a monthly payment if you finance. And assuming you finance that at 4.9%, which I know at Summit we finance for less than that, but that's just to show you we're being fair with the numbers here. You'd find that the difference of payments between financing a $15,000 used car and a $45,000 new car is $564 a month, assuming you're financing it for 5 years. And instead of doing the Instead of buying the luxury car, if you took the difference of those payments as if you were going to buy the luxury car and instead invested it at 7% annual returns, which many in the stock market would call that too low, but I'm trying to be very conservative here. You'd find that you've grown over the time period from the time you were 20 years old when you bought your first car, and only one car, and just did it one time. By the time you were 65 years old, when you were nearing retirement age, you would have been able to build a portfolio worth $659,000. So that one car purchase cost you $659,000 by choosing the luxury over the used. I point that out because we're all facing that decision 4, 5, 6 times during our lifetime. Of course, it has a bigger impact when you're a young person doing it versus when you're an old person like me or maybe some of you, but it still has a big impact. So I want to point out that one car decision costs us the ability to save over $500,000 in our lifetime. If we repeat it 4 or 5 times, imagine what that really allows us to save. I'm going to hit this one close to home, and I'm sitting here with my lunch bag right next to me because I put this one to action every day, but very often it's really easy to say, I need a break, I need to get out of the office, I'm going to go get a lunch. And the cost of that is tremendous, though we don't realize it. So I figured out that I can make a bag lunch for about $2.50, but instead, if you went out and bought what I would call a cheap lunch now, $8.50, believe me, you can spend $15, $16 on a lunch nowadays very easily. But I assumed you're eating out at Subway or something like that. Even a McDonald's meal is now about $8 with a drink. What you'll find is the difference of those daily purchases, $8.50 versus $2.50, takes away your ability to save about $130 a month. If you can do that during your working lifetime, from the time you're 20 till the time you're 65, and you took that money and again invested it at a low 7% annual growth rate, you'd find that you could save just under $500,000, $492,000 by the time your retirement age. These lunches are very expensive, though they don't feel that way when we're buying them. Already, I've shown you 2 different ideas that the average person could save over $1 million by the time they're retired. The last one I'm going to hit on is just home purchases. We all want one. We all have one at some point. And sometimes we want too much of a home. So we all need a home. And I'm going to compare the home purchase that costs $250,000 versus the home purchase at $150,000, both easily doable in the Triad area. If you were to take the difference of monthly payments for the $250 versus $150, and then you took that and again invested it at a 7% annual return. That, by the way, is the return of the Dow Jones Industrial Average over the last 30 years. What you'd find is you'd have the ability to save. If you did that purchase at age 25, that home purchase, you'd have taken away your ability to save an extra $618,000 by the time you reached 65. That takes our grand total of ability to save by retirement age to about $1.77 million. Now, I know most people don't have $1.77 million, but I've just shown you how all of us could have $1.77 million by the time we get to age 65. And we can go up from there by just applying these same ideas throughout our entire lives. I'm pointing that out just because oftentimes I'm doing financial planning and we're always facing the decision of, I need a car, I need a house, I need a lunch. And these are things we just take for granted we need to do, but if we examine them a little bit and tweak them, we can start to unlock our ability to save more. Now, I help members start with as little as $50 a month saving for retirement. So don't think you need to be a millionaire, but there's only one way to become a millionaire, and that is to start saving. So definitely call us if you're interested and curious about investments. We help members that invest with no risk because many people don't like the idea of the stock market. And we do help about 1/3 of our clients don't take risk in the stock market. But for those of you that want to know about those plus things having to do with the stock market, we certainly do all of that as well. We're here to help you. Feel free to reach out to us anytime at any of our branches. One of our advisors can certainly help you at any of our branches, including me in the Triad. Okay, thank you.
Thank you, Mark. We appreciate you.
Yeah.
Now, if you all have a question or comments for our esteemed panel of experts, you can type it in the chat or raise your electronic hand to be called on and unmute. While everyone's thinking of good questions, I'm going to go ahead and present a few for each of you. And that might help everyone to get those questions in mind. Let's start with you, Dirk. What are some misconceptions about the home buying process that you could share with us?
Well, a lot of misconceptions are, especially in today's world, the no down payment loans. There is a few programs nationally that will allow a no down payment on a purchase, but it's subsidized money through local government and local programs through the local government and HUD departments that you've got to qualify for. And it can be very difficult to qualify for these. So in most cases, you've got to have down payment and some closing costs or some of one or the other. So the days of getting into it with little to no money down is not as prevalent as it was in the past. And we see a lot of people that come into it, hey, I'm ready to buy. You know, how much, you know, I don't have any down payment. But when you try to get into those programs, again, those programs are very restrictive. There's the loan sizes cannot be very high if you make too much income. I mean, there's just so much that goes into them, and there's very few lenders that actually do them. So that's what a huge misconception in today's world. And then the second and probably the biggest one that we here at Summit face, and it's a nationwide challenge right now, is timeframes. Right now is an unprecedented time in mortgage lending across the nation. We're at all-time low rates. We're at unbelievable amount of numbers of people wanting to refinance, and everybody's trying to buy while the rates are low. So you have all this coming in, and we have the COVID issue. The third parties such as appraisers and home inspectors that have to come into the houses and do everything for them, a lot of them is just refusing to do it. And so it's throwing the process, it's slowing it down. And what used to could be done in 30 days is typically not happening in 30 days. It's taking as much as 45 days or longer at times. And it's not just Summit Credit Union, it's a lot of companies. And there's a lot of companies going to promise people up front, oh, I can do it in 30 days. And then you find out, well, you can't. And it's just that they're trying not to lose the business and the members and the customers that they've had in the past. But that has just become one of the single largest issues I'm seeing. It has gotten so bad that some of your major banks have cut out refinances outside of their current customers or membership. A national bank that's headquartered locally here in North Carolina, they will not do a refinance if you don't already have your mortgage with them. Another national company has cut out home equity loans simply because they just couldn't keep up with demand and didn't want to disappoint. So it's quite again, unprecedented time, and everybody's working through it, but give the lenders, give them their time. They're trying their hardest. The appraisers, the attorneys, everybody involved in the process is really working hard to make it through this.
Thank you, Dirk. I know that the mortgage department does a lot here at Summit Credit Union to make our members as happy and yet have it happen as efficiently as possible. But that's a very valid point. Now, we did have a few questions in reference to estate planning. Mark Lopresti takes care of our estate planning here. Care to share anything specific about that, Mark?
Yeah, I was actually just typing a response to that. I'm glad you brought it up. So we do full estate planning as a CFP. I do full estate planning all the time. And sometimes that's going very deep into very complex things that we can't cover on this. We cover 40 areas of financial planning, and there are over 40 different types of trusts. So I don't want to go too deep into this stuff, but we can certainly help you understand and plan for all areas of your goals. And that includes estate planning for basic goals as well as complex planning for more extensive goals.
Great, thank you.
Mhm.
If you want to screenshot this, please feel free to do so, because we want you to have access to all of our experts' information. It's also on our website, but just to make it easy, it's here for you today. You got the face, the name, the numbers, everything. I want to go ahead and ask Vicki, are there any benefits to getting my insurance packages reviewed annually if I already use you as my agent?
That
Okay, one more time with the mute. There.
That's always a good thing to do, because each company may choose to take a rate increase during the year. So if you're with Nationwide and they choose to take a rate increase, and say Travelers does not, their rates may be more competitive at the time. So when it's time for your renewal, maybe 30 to 45 days prior to that, just give us a call. We'll be happy to review that, because that could make a sizable difference in what you're paying as far as your premiums.
Great, thank you. And Mark, we had a question. Brian
Yeah, I
said
was just
he's got
reading that.
about 6 years till retirement. When does he start planning?
Yeah, well, the answer to that is right now, today. We never stop planning. We never stop goal orienting everything we're doing and the decision making we're making. Right now, you're starting to hone in on those final years. You definitely don't want to make a mistake at this point, because you don't have the recovery time that you had, over the last 10 years. I'll warn you, just to give you an example of this. Back in 2008, many people were not thinking the way you are thinking by asking that question, and it caused many of them to have to delay retiring for a decade. So just be aware, you're honing in. That last 5 years is kind of the crunch time. You want to make sure you don't have a big market event that delays your retirement. And so what is working right now may in fact be the worst thing for you if you do plan to retire in this next 5 or 6 years. That's always a tough one, because back in 2008, there were certain investments that were working really well, and you couldn't share with people the risks of those investments because they wouldn't hear it. You would share it, they just wouldn't hear it. So they would go to the person that tells them what they want to hear rather than what they need to hear. And oftentimes those same people were the ones that couldn't retire when they finally reached their time frame. We're in a dangerous time. I don't want to give you guys a warning, because none of us knows the future. I certainly don't. I've been investing for about 34 years now, 33 years. And this is a strange time in terms of we're looking at things happening in our economy we've never seen happen in our lifetimes or anyone's lifetime. So if you want to explore and understand and discern what's going on, feel free to call me. We can go into depth on that. But things are going great right now, and we're all doing really well. It's not the time to put your guard down, though, about what could happen. Okay, thank you.
Mark, what specifically encourages you about the current economy in regards to investing?
Well, and as an investor that works with stocks as well as other things, stocks are doing great. We're in a golden time where stocks are going up at the fastest rate that I've seen in the past 20 years. Is it a healthy economy? Is employment at full max employment? Is inflation under control? No, neither of those things are. So are there warning signs that something could go wrong? Sure. Why is it not going wrong should be your question. And I can explain what that is, but I really don't want to do it on a webinar. I want to have that as a one-on-one, because it's going to make you ask many other questions. It's just a strange time. So be aware there's some things that most people are not aware of.
Sure. Matthew had a question. Does it ever make sense to borrow against your 401k versus taking out a high interest loan?
All right, well, that's a trick question. So if your choice was a high interest loan only, what's high interest? I would say something in the 7% and above range. Then I probably would favor my 401k loan, but now let me bring in a warning. So in 2008, it was very common to borrow on your 401k to help with anything, home down payments, car purchases, and all of that. What happened right after that was the market crashed, and then people simultaneously lost their jobs. So at the point in time when they had no income, they also had an event occur where they lost a job and the loan suddenly became taxable. So imagine this, you just lost your source of income and now the IRS is coming to collect on a giant loan. That's a bad scenario. I would never borrow against my 401k unless I had no other choice. So I really don't like the framing of your question. There might be other ways to get money. It might be better to just take the money out of the 401k if you're over age 59 and a half and your employer allows it. Might be better to get sources of money from other things. Might be better to downsize. I know that this is not an easy answer to give, but oftentimes we're phrasing questions that structure us into corners we shouldn't be. I'll give you a common one. Mom, dad calls me, I've got to help my son or daughter, they're about to lose their house. How do I get money out of my 401k? And my answer almost always is don't let them lose the house. I don't mean don't let them lose the house. I'm saying don't take the withdrawal, let them lose the house. Why? It's not the end of the world to lose a house. I mean, I know Dirk showed us the damage to your credit report and Lindy did, but there's a reason they lost the house. It's underwater and they can't get a new loan or they've lost a job. This problem may not go away. And oftentimes we feel like the quick answer is the best answer. That's not always the case. We need to keep in mind what our goals and long-term objectives are, and then also the risks of these decisions. So getting back to your question, a 401k loan can be the riskiest decision of your life, especially if the market corrects and you lose your job next, which could happen.
Thank you, Mark. And I
Sure.
would say, Matthew, to piggyback a little bit of what Mark said, it could be that what you really need is a credit score analysis so that we can look at your credit picture and see if there's anything that you're missing in reference to options. Because oftentimes people think it's this or that, and there's really other things in the middle somewhere that could be useful to know. Let me ask this of Vicki. Do you have to be a member of the credit union in order to take advantage of what you have?
No, you do not have to be a member. So reach out to any of us. We would love to help.
Yeah, that's the same thing for you, right, Mark?
Absolutely. I hope any of our members, children of members, non-members, I will tell you, many of them become members somewhere in the course of us helping them, not because they're required to, but they end up needing something that having a membership makes it very convenient to help with. But no, not a requirement. Just you'll find that there are reasons we end up becoming. By the way, to become a member, even if you're not an employer-based automatic free membership, to become a member isn't that expensive. I mean, it's very little. It's cheaper than a burger at McDonald's, I think. I don't want to swear to that because I haven't bought a McDonald's burger this last week, but so you can find a way to become a member without it really having a big impact on you.
Okay, thank you.
Mhm.
We have a question from Denise. Does it make sense to have a screened-in porch built onto your new home if you're a new homeowner, especially if your home value is already pretty high?
That one's for Dirk.
Oh,
Okay.
thank you, Mark. It can help. It probably is not going to do very much for the value on the property because heated and cooled square footage is what changes the value the most. Yes, your eye appeal for that's gonna help as long as you keep the screens nice and keep everything out there looking good. Yes, it'll help on that end. But as far as pure value, it's probably not going to change it very much, if any. And we do get that question a lot. We get it a lot with townhomes because a lot of townhomes nowadays are built with screened in porches. And some people want to say, hey, well, I want to enclose it and take the screens out and put maybe something in, but I'm not going to heat and cool it. Until you heat and cool square footage, it really don't change the values very much.
And I can share that appraisers won't give you any value for the screened in porch, but my wife, anytime we look at a property, she'll right away, does it have a screened in porch? So it's important to some buyers. I'll just put it to you that way.
That is correct.
Might help you sell faster.
Yeah, appraisers will not give it value under any circumstance.
All right, good questions, good answers. Thank you, panel. I will go ahead and let's go to the final screen here. If you're interested in a virtual credit score analysis, please contact me or any of our fabulous member service representatives for a face-to-face CSA. We hope that you take advantage of all our resources available to you, including the 3 panelists that we're speaking today. They are available to credit union members and non-credit union members. Thank you so much. Have a great day.